Introduction to bonds and bond pricing. Bonds make up one of the biggest financial markets on the planet. Billions of dollars are traded every day and trillions are issued and bought each year. In this series of videos, we will look at bonds and the bond markets in detail, helping you on the way to unlocking the world of fixed income. What makes the fixed income markets work? Who are the buyers and sellers? And how do they think about their investments and the risk? These are some of the questions that we will look at in this first video. In later videos, we will look at the different sectors of the bond markets and how they trade, how bond investment portfolios are constructed, and how the various instruments can be put together to meet specific investment objectives. We will also, along the way, cover the mechanics of bonds and how they trade, building this up rigorously but intuitively with relatively few mathematical formulae. What is a bond? When individuals borrow money, they generally borrow it from a bank or finance company. The same's true of small companies, but larger companies, banks and other financial institutions, and sovereign governments are also able to borrow money in the capital markets by issuing bonds. A bond is a security. Think of it as like a certificate that represents the debt of the issuer. Whoever buys the bonds becomes the lender, and the issuer of the bonds owes the money to them and pays interest to them. Investors with capital to put to work may choose to buy the bonds when they're first issued in the primary market or later in the secondary market. Holders of the bonds earn interest that's paid by the issuer. For most bonds, this is in the form of periodic interest payments called coupons, expressed as a percentage of the money originally borrowed. Here is an example of a bond which shows why the interest payments are called coupons. This is a bond issued by Lindsey Materials Company with $100,000 principal amount, meaning it represents $100,000 that was originally lent to the issuer and which will be paid back at the end. When the bond was originally issued, LM Corp borrowed at a rate of 3% for 5 years. And so you see there are 5 annual coupons of $3,000 attached to the bond and a large piece, the face of amount of $100,000. Originally, before securities trading became an electronic process, bonds were physical instruments, pieces of paper. And on each coupon date, the holder of the bond would cut off the coupon and present it at the issuing and paying agent in return for the interest payment. This is why you may still hear the phrase clipping coupon to describe a bond investment strategy that's focused on earning the interest income. Why invest in bonds? Bond issuers are generally issuing bonds to raise money they need to borrow. So why would investors buy the bonds? Generally, this is because they want to invest capital to generate a return. But if they want to generate returns, why not invest in the equity markets or in property? It's generally stated that the expected long-term return on equities is higher than on bonds. So why not go there? Well, bond investors are typically looking for a specific set of characteristics from their investments that equities will not give them, or at least will not give them alone. Bond investors are typically looking for relatively low-risk investments, and they will accept that this will come with a lower expected return. They're also looking for stability and certainty of future cash flows, or looking for income. Fixed income investment may be part of an overall strategic asset allocation, where an overall investment strategy is allocated across cash, fixed income, equities, property, private equity, and hedge funds. Or, and this is actually the case for most fixed income investing, at least by volume, they are investing in order to meet a set of future liabilities. Defined benefit pension schemes and life insurance companies make promises to pay money out in the future, either to retirees until death or on the death of insured lives. Either way, those future cash flows are driven by mortality, and the future cash flows are modelled by actuaries who estimate when scheme members will die based on broad factors. Once this is done, The liabilities of the scheme or life insurer are a set of fixed future cash flows. And in order to best meet these future cash flows, mature defined benefit pension schemes and life insurance companies are some of the biggest investors in bonds on the planet. Alongside, of course, central banks, who've been the biggest buyers since the financial crisis as part of their programs providing liquidity to the markets. Bond prices and cash flows. It's a good idea in fixed income, and indeed in the rest of finance, to think about cash flows. If the original bond was issued at 100% of the face amount, the investor would have paid $100,000 for this bond. They would then be entitled to each of the annual coupons. Whilst the LM Corp bond was priced at 100% of face when it was issued, the price may be different in the secondary market. For example, if at a later time, investors are generally happy to lend money to LM Corp at a rate lower than 3%, then this bond would trade for more than 100. For example, if investors were prepared to pay 105 for the bond, they would be earning 3 for every 105 they invest, which is only about 2.9%. Plus, if they hold the bond for the 5 years and get 100 back at the end, they've lost 1 per year, bringing the yield down to about 1.9% per year. Similarly, if investors needed to earn more than 3%, then the bonds would trade at a price less than the par price of 100% of face. Bond cash flows and values. This can be seen clearly in a zero coupon bond example. Some short-dated bonds do not pay investors any coupon. Well, why would the investors buy these? Because they can buy them for less than 100 now and get 100 back at maturity, for example, in 1 year. If a zero coupon bond can be bought now for 90 and in 1 year pays 100, then the investor's getting a return of 10 on 90, which is over 11% per year, which is very high compared to today's market. I just use that as an example. If the price of the bond rises from 90 to 95, then the return now is only 5 on 95, or about 5.3%. As the price rises, the interest rate or yield falls, given that the cash flows are fixed. For the same set of cash flows, if you pay a higher price, you're getting a lower return. Bond yields and prices. Bond yields allow investors to compare bonds with different cash flows. Imagine choosing between 2 bonds as an investment. Both are issued by the same borrower with the same legal provisions. Both involve investing for the same time, let's say 5 years. Both redeem at 100 at maturity. Bond 1 is priced at 95. Bond 2 is priced at 105. As a junior fixed income analyst, you're asked to choose between them and make an investment recommendation of which to buy. What do you think? Well, those of you who said Bond 1 should give it some more thought. And those of you who said Bond 2, well, you also need to think again. The answer, as so often it is in finance, is it depends. So what does it depend on? Well, it depends what coupon you get. If Bond 1 pays a 1% coupon for 5 years and Bond 2 pays a 2% coupon for 5 years, it's going to be better to buy Bond 1. Buying Bond 2 would involve paying 10 more up front, but would only give an extra 1 per year for 5 years. But what if they have coupons of 1% and 3.25% per year? Now it's a bit trickier. And this is where yield comes in handy. Whenever people talk about bond yield, they generally mean yield to maturity. On any given day, given a bond's cash flows, if you know the price of the bond, you can calculate its yield. And if you know the yield, you can calculate its risk. They're interchangeable. However, the yield numbers are more comparable and they're therefore more useful for you as a junior fixed income investment analyst. There are many different tools available to calculate the bond yield from the cash flows, including proprietary industry tools. However, it's also possible to do it using a spreadsheet. Here, we use a very simple function called rate, which takes as its inputs FV for future value, the 100 at the end, PMT for the payment, so that's 1 per year, N per, which is number of periods, that's 5, because there are 5 years, and PV, which is present value, which is minus 95 for bond 1, and we solve for the single rate that can be used to relate the future cash flows back to the present, we get 2.06 for the yield to maturity. Note that we use minus 95 for the present value, the price, because that's a cash flow out, and all the others are cash flow in. If we do the same for bond 2, we pay out 105 and we get 3.25%, then the yield to maturity on bond 2 is 2.18%, and so you would favour bond 2. Yield to maturity. Technically, the yield to maturity is the single interest rate that can be used to discount future cash flows to get the price. It's a forward-looking measure and as such is not a guarantee of return. In fact, amongst the many definitions of yield to maturity that you might find in the many standard bond math textbooks, my favourite generally does not appear. And that is, the yield to maturity is the single interest rate which, if you buy the bond and hold it to maturity, you almost certainly will not earn. Why is that? Well, the return that's actually earned on the bond, if held to maturity, is driven by the amount of money the investor ends up with at the end. And that, in turn, depends on what the investor does with the coupons along the way. If they just leave them in cash, earning nothing, then the return will end up a lot lower than the yield. But if they reinvest them and interest rates have risen significantly, then the return earned could be much higher than the yield. So if yield isn't return, why is it any use? Well, if you, as the junior research analyst in fixed income, choose the higher yielding bond, you would, all else being equal, expect to earn a higher return. So one of the best uses of yield is as a measure of value, including, as per our example here, relative value. The yield curve. Here are some government bonds from the 2nd of January 2018. The graph here is called the yield curve, and such curves are used almost constantly by investors to examine the possible yields on investment in bonds of a given bond issuer. Curves tend to be shown for a single issuer or sometimes for a group of related issuers. You can see that the yield on the 2-year bond is 1.92%, whilst the yield on the 10-year bond is higher at 2.46%. This is often the case in bond markets, where the investor gets a higher yield per year for investing in a longer-term bond versus a shorter-term bond. The argument is that they should get more for tying their money up for longer, and this is why the longer bonds have a higher yield. This is often referred to as a normal or upward sloping yield curve. Occasionally, yields on the longer term bonds fall below those on shorter dated bonds. This is unusual and is referred to as an inverted yield curve. Many commentators see such a curve as a precursor of recession, although that view was questioned more recently. Using the yield curve to express views on the market is fundamental to fixed income investing and will be explained later in the series. But first, there are some more details of the bond markets that you need to understand.